Alpha. This is episode 169, and we have a very special guest on. His name is Daniel Krueger. So Dan graduated from University of St. Thomas in St. Paul, Minnesota, with a degree in financial management. Before beginning his career as a real estate investment professional, he spent 5 years working in corporate finance, where he managed the operating expenses for multinational Fortune 500 companies. In January of 2018, Dan closed on his first property, a small 6-unit apartment building in St. Paul, Minnesota, for $475,000. The business plan was simple: fix set up the units, approve the tenant base, and increase rents to the market rate. So 9 months after acquisition, Dan refinanced the property at the value of $600,000. He used the refi proceeds to get into the next deal, which is the 8-unit building about 3 minutes away from the first property. So now in 2019, he joined the forces with Anthony Vicino to launch Invictus Capital. And of course, for more information, that's invictusmultifamily.com is the website. So now they acquire and manage multifamily assets in Minneapolis, St. Paul market, and allow investors to participate as well. Invictus currently has a portfolio of about 100 units and plans to acquire another 900 units over the next few years. Their goal is to accumulate upwards of 5,000 units by their 10th year in business. So, and of course, social media links are going to be down below there in the show notes for you to get in contact with Daniel personally. So Daniel, again, thanks again for coming over today. I really appreciate it.
Thanks for having me. This is fantastic. Excited.
Thank you. It's a very long bio. I think it's pretty much, I think it matches Anthony's as well. Something like that. Because if you guys don't know, we spoke with Anthony Vicino previously. You can actually go and find that episode as well. But having Daniel is kind of, as I told himself, just having maybe a different perspective from partner about the business and what they plan to do in the near future. So again, talking about your own personal kind of background, can you take us back to 2019, closing your first property, or maybe even before that, and tell how did you get involved with real estate?
Yeah. So I've been obsessed with investing and trading and anything finance oriented for a very long time. And so I was coming into real estate with a background of someone who's just really into investing in general. And so it's kind of ironic that I stumbled on it after trying just about everything else. But I came across it while I was still working in the corporate world in finance, but I was already kind of mentally checked out and really getting attracted to more entrepreneurial endeavors. And I had a side business going on the side. So I was already kind of moving in a different direction mentally. So while I was working, I would listen to a lot of audiobooks and podcasts, and things like that. And somehow stumbled upon the audiobook of Rich Dad, Poor Dad. And I'd been hearing about it since the 90s when it came out, but it seemed so cheesy and gimmicky. I'd never, taken it too seriously, but I was kind of running to the bottom of the barrel on stuff to listen to while I was working because I was just, bored with the corporate thing, and gave it a listen. It was really, really interesting. And that was the impetus to start diving into real estate. And, after doing, trading stocks, futures, options, Forex for a couple of minutes, after doing all that other stuff, real estate just seemed so simple and understandable and less like gambling than anything else in the investing space that I'd played around with.
Mm-hmm. Got it. Okay, so it's kind of no-brainer, especially you having a little bit of experience, as I mentioned, in stock trading and stuff like that. So now you understand the power of real estate. But again, the first deal, I love the fact that you didn't look at the single-family homes; you just took off with a 6-unit apartment. So can you talk about kind of decision-making process? How did you pick that specific kind of very specific like multifamily niche instead of going, flipping houses or doing wholesaling or whatever else? Why multifamily?
Yeah, well, one of the things that really attracted me to real estate, like I said, was the fact that it was such a simple business model, and it seemed so much less risky than all the other stuff I'd been playing around with because you had so much more control over things, specifically over the valuation. When you look at how multifamily properties are valued compared to a single family home or a duplex or a triplex, with those smaller properties, your valuation is based on comparables. So you're still exposed to some of that market risk that you don't get as much exposure to at least not to as great of a degree in multifamily, where the valuations are like you're appraising a small business or any business. You know, you're looking at what is the net operating income, how much cash is this asset producing. That's the biggest factor in determining the value, not what Joe sold his apartment building down the street for last month, right? That gets factored in, but not to as great a degree. And at the same time, you've got this cash flow element that, you know, you still have in smaller properties, but there's less of a likelihood of you going into a negative cash flow situation when you get larger properties, because, you know, with a duplex, one person moves out, you're 50% vacant. You may or may not be making money at that point. With larger properties, you know, if you're operating them well, usually your break-even occupancy is going to be, you know, anywhere from 60, maybe up to 85 or even 90%. It's low with the types of assets. It's rare with the types of assets that we get into that occupancy ever dips down that low. So you still have that cash flow to support you while you're, you know, waiting for the market to rebound if there ever is any kind of downside move with real estate. So that's really why I got into multifamily stuff, specifically things over 5 units, is basically because of that valuation aspect. And also when it comes to debt, the bank looks less at the individual borrower and their income and more at the property to see if they will lend on it. So it's not like, you know, hey, does Dan's W-2 paycheck pay for this property? They're looking at, does this asset support itself, right? So that was another factor that was I guess you could say is easier than the smaller properties, depending on who you ask.
Yeah. So because you're buying an existing business, I mean, when you go and buy a single family house, you're buying real estate, you're buying a house. But when you buy, let's say when you acquire a multifamily apartment complex or whatever, that's 5+ units up, you know, like you buy an existing business, and as you said, bank will definitely take a look at that if it cash flows positive, first of all, and if it makes sense for them to borrow, you know, the money. So again, I'm talking about that because currently you're looking to buy these assets in Minneapolis, St. Paul market. So can you talk about that process, like, and how does those markets compare to this, like, surrounding markets? Can you give a little bit of an insights into that?
Yeah, sure. So, you know, for your listeners who aren't aware, Minneapolis, St. Paul, those two cities are very close together in Minnesota. So really we look at those as essentially the same market. The drive time from downtown Minneapolis to downtown St. Paul is, you know, less than 10 minutes. So we can kind of look at them collectively as a market. There's obviously nuances between the two of them, but for the most part, we look at those as kind of one thing. The next most comparable markets for most people would probably be, you know, Chicago, Milwaukee, you know, stuff in the Midwest area is fairly comparable. And then you've got the coastal cities and all those other markets that we hear about more. They're kind of the hot markets. Everyone wants to be in the Southeast these days. So probably people are most concerned with how does it compare to those areas. And what you'll see, especially if you back test our market and look at how it performed in 2005, 6, 7, 8, 9, 10 through that time period, you'll see that it's much more stable than some of the other hotter markets. So we might not be seeing some of the cap rate compression that other markets are seeing. We might not have some of the rent growth long term that other markets are seeing that might be booming, but we also don't have as much volatility in our market as well. So right now it's, you know, just looking at current data, I think we were in the top 5 markets in the United States for lowest unemployment. So if we're looking at unemployment across the US, Minneapolis, St. Paul is actually doing a heck of a lot better than the vast majority of markets, which is great. That's probably one of the most applicable pieces of info right now, just because we've seen this big paradigm shift over the last year. So the job market's great, and it's really a diverse industry in this area. So we've got multiple Fortune 500 companies. You don't have like a Detroit situation where there's kind of one industry. We've got lots of universities, healthcare, Mayo clinics here, tourist attractions like Mall of America, General Mills, 3M, Best Buy, Target, like all these really great companies across multiple different sectors. Again, just provides a much safer environment for uncertain economic times from a job perspective.
Yeah, and especially during these times, employment and jobs, and again, what you mentioned, you know, like you kind of having this kind of slow but steady growth, which, you know, which like you know, that's perfectly fine. You don't have to go in probably in the markets where, you know, like all these Fortune 500 or Fortune 100 companies coming in, and it's all exciting, and which is good at the same time. So on that note, it's like, are you planning to kind of look to different markets and to when it comes to investing as well, or are you going to stick to those currently?
Yeah, right now, our business model is to stay as vertically integrated as possible. So right now we have property management and maintenance in-house, which gives us a leg up on other operators because we get those expense line items at a wholesale cost, basically, as opposed to going to third-party vendors for those types of things. So that saves us a lot of money, provides us a lot more control as far as how the assets are actually run. Actually like boots on the ground day to day. It gives you a greater degree of control than if you were using a third party for that, which we like. Like I said from the get-go, and this is true for Anthony, my partner as well, we like to really kind of control all the processes and systems to make sure that everything's working as good as possible, as opposed to outsourcing things. So right now we're staying vertically integrated, which keeps us in this little market right here. But there's a few other operators who have been doing this for 20, 30 years ahead of us, who've accumulated really nice local portfolios, thousands of units just locally. So I'm not opposed to that. More than likely, we'll see some diversification in the future, but it's probably not going to be until we get well over 1,000 units locally to be able to have a hub for our own in-house property management wherever we start to expand to. I think that's probably the way that would scale. Or we would probably partner up with another group that has on-site presence in another market that would still give us that kind of in-house control, even if it's a GP partnership of some kind. But
So I think I asked the same question to the Anthony, but I just want to get your take on that as well. Is like, for the multifamily investors who are watching or listening to this episode, is like they're probably thinking about getting a vertically integrated property management company as well, but is there a specific number that you have to take a look at and say, okay, now it makes sense, we can kind of create in-house property management company instead of hiring a third party? Like, what type of recipe people should use for that?
yeah, well, first, I want to say we just did a podcast on our end talking about this recently, and it's a topic that comes up quite a bit, the question of whether to handle management in-house, not necessarily where you're going door to door to get rents, but where you have salaried employees doing this for you, or going to a third-party company and paying them, whatever it is, 7-8%. Everyone's got their own fees, but usually effectively they're probably going to cost you somewhere between 5 and 10%, depending on how big the portfolio is. So the question is, do you do it in-house or do you outsource? Obviously, one of them, the barrier to entry is pretty low. Outsourcing you can do from day one. And to your point, it doesn't really start to make sense until you hit a certain number. Where we've found that it really makes sense in the numbers, where you actually start to see some cost savings on the expense line items, is when you start to get past that 100 unit mark and you have one person on property management and one person on maintenance. That level of headcount can do pretty well with a portfolio of around 100 units, and that's where it starts to financially make sense, where you're actually saving money as opposed to outsourcing to a third party. We wanted to get ahead of the ball on that and do it before it actually saved us money, so that we had those systems and resources in place, allowing us to scale a little bit quicker and just be ready for higher number of units in the future. It also provided a little bit of motivation to grow quicker, because all of a sudden we've got headcount to support, and that's another incentive to go out there and accumulate properties so that it actually makes sense on the P&L. But from what I can tell, it's right around 100 units. But really, at the end of the day, you could do really great in real estate doing either one, in-house or third party. I think we're probably the minority doing it in-house. A lot of people do it out through third party and do just fine. So I think it really comes down to someone's personality, whether they really like to get in the weeds and micromanage that aspect of the business, or if they'd rather keep their mind focused on something that they enjoy more or are better at. And that might be networking with investors, might be putting out content, managing the brand. Maybe their time isn't best used worrying about the property management issues. And for those individuals, it might just be a better fit personality wise to go to a third party.
Got it. So few questions on our property management side still, because I think other benefits would be, instead of having in-house, I'm talking for the people that kind of starting multifamily syndication business, instead of having that kind of vertically integrated, if you hire, because some of the companies out there, like I'm sure you got everything figured, and of course we can talk about that a little bit more in detail, but for the brand new people, they could be struggling in the times like these, because they don't have property management experience. And
Yeah.
when it comes to the rent collections and just maintenance issues, they could be finding themselves in a very difficult situation right now, because this is one of the situations that nobody planned for. They knew
Yeah.
that the economy is going to go down, but they never thought about that this is going to be happening. So can you talk about your personal experience? I mean, how you guys are currently having, I mean, have you had any problems, or is everything kind of perfectly fine with the rent collections? Because, there's more than a few operators that I talked with before, and they're kind of saying that that's a little bit of an issue right now.
Yeah, I mean, it really depends on what asset class you're looking at, what market. I think across the board, it's pretty safe to say that um, the asset classes that are getting hit the hardest are the higher end of the A class area, where especially in those really urban areas that are densely populated, that a lot of people are getting kind of turned off of now, whether they're afraid of COVID or whether they just don't need to be dead center downtown because they're working from home now. That combined with people getting furloughed and unemployment going up, people's ability to afford their rent is going down. And so those A-class units usually take a hit. And that's what we've seen locally. The brand new builds, A-class properties in the best areas are the ones where you're seeing more concessions, vacancies going up. There's a month free, 2 months, maybe even 3 months at certain properties. In our properties, the only thing that we saw was there was about 2 months or so where marketing units was tough. Basically, end of March, April, and most of May was tough for marketing units that we had renovated because people just weren't out shopping for a new apartment at that time. That's right when the shelter in place started. That's when we knew the least and everyone was the most scared, and there was as much panic as there was. People just weren't out shopping. Everyone was just sitting, waiting, to try to figure out what the heck was going to happen. Rent collections, the only thing that we saw was a delay in people paying, not necessarily a reduction in collections. So where we normally might have 90% of our rent collected by the 6th or the 7th, and then 100% by the end of the month, for a while there, we weren't able to charge late fees. So a lot of people lost their incentive to pay by the 5th. So what happened was by the 15th of the month, we might just have 50 or 60% of our rent in, but then by the end of the month, we'd have 100%. So people took a little bit longer to pay because there were no late fees, which makes perfect sense. I wouldn't rush to pay by the 5th if there was no late fee. So that's really all we saw on the rent collection side. So outside of the delay and marketing units, we haven't really seen much downside. We've had, I think, 2 tenants since this whole thing started who have reached out and let us know that they were in the hospitality industry and their hours had been cut. But otherwise, we haven't really seen a blip in people's ability to pay yet. Next year might be more pronounced because I would bet that we get less stimulus money going out, and that's probably going to put more of a strain on things. But at the end of the day, since we invest in C-class assets, we're really well positioned for people who are downgrading from an A or a B. So the influx of qualified tenants who are downgrading their lifestyle should offset any issues that we have with tenants who are negatively impacted by COVID. So,
yeah, okay.
So far, so good.
Yeah. So hopefully it will continue that way, but of course we have to just always, I guess from my perspective, do the worst case scenario, especially these times we have to be just.
So we spend all our time looking at.
Exactly. So again, the second question that I wanted to have about property management, again, let's say somebody made a decision to create in-house property management company. I mean, does it make sense for them and maybe for you at the same time to take on somebody else's properties and manage them as well? I mean, do you have that kind of idea going as well?
Yeah, we don't plan to do that. So I don't have any personal experience in that. I know that the property management business on its own isn't a big moneymaker. So I don't think the returns you make from managing other people's properties are going to compare to what those returns on your resources would be if you were to just manage your own. So the numbers don't really make sense there. And we do know a couple of local guys who have utilize that business model. And they have said that about 90% of their headaches from running the business come from the side of the portfolio that they don't own, that they're just managing for other people. So really at the end of the day, they're taking on more headaches and more issues, but they're not really making any more money or anything. So outside of it potentially putting you in a position to source new deals, it's usually going to be a suck on resources. So we haven't put any attention into growing that business plan.
Got it. Okay, makes sense. So these people saying they're busy, basically most of the time. I'm busy. That's
Yeah,
what they say, right? I'm busy. I'm running
exactly.
places, but it doesn't make any sense financially, right?
Mhm.
So okay, so again, talking about the deals, because you mentioned that you're looking for C type of deals. So can you go a little bit
Mhm.
more into specifics, like the minimum amount of units you're looking for, and
Yeah.
how do those like properties look like, and maybe the ways that you're sourcing them currently?
Yeah, so I mean, we have a criteria. We have some criteria that we communicate to brokers when we let them know what we're looking for, and then at the same time, we always look at everything because there might be a great opportunity for something where Anthony and I just do something by ourselves, or maybe with one other person as a joint venture, even if it's a little bit smaller than what our official criteria is. But what we tell brokers is 50 to 150 units, something with a little bit of upside potential, where we can either add new revenue or increase rents or do something to force a little bit of appreciation. And something that we've shifted to now post COVID that was different before is that criteria has shifted a little bit. We used to be looking for heavier lift, bigger value add opportunities,
Mhm.
whereas now we're looking at properties that are fairly stabilized and have some upside potential. They don't have quite as much upside, but at the same time, we're able to carve off some of the risk about not knowing what's going to come in the next couple of years by acquiring properties that don't necessarily need us to execute that value add business plan. Like the deal we just closed on a couple of weeks ago is just that, it's 100% occupied. There's 20% delta between current rents and market rents, so there is some upside potential, but the tenant base is fantastic. Buildings are in great shape, so we can wait multiple years to execute that business plan if we want. It cash flows from day one. But as soon as we feel comfortable, we can start to upgrade those units and bump rents a little bit, but we don't necessarily have to. So that's really kind of what we're honing in on for the next year or so until things really start to prove that we're, rounding the curve and are officially putting this whole thing behind us. But for the time being, we're looking at things that are a little bit lower risk and basically that aren't contingent on having a value add business
Mhm.
plan. Whereas the deal we closed in January of 2020 was a value add deal, but there was no other option because the tenant base was rough. We had to re-tenant the entire building. There was no way around it. So having that type of asset in this type of environment is a little bit more risky than it was about a year ago.
Mhm. So, but we're still talking about, even though you're not looking to do kind of heavy value add strategy as you did prior to COVID, like we're still talking about the C type of properties, right?
Yeah, but I would say the one we closed on a couple of weeks ago was more of a little bit closer to a B class property in an A class neighborhood.
Mhm.
So it's in a neighborhood of St. Paul that's kind of, I'd call it the old money neighborhood. So it's where all the old turn of the century from around the 1900s mansions are. Some really great private universities. That's where St. Thomas is, where I went. Net worth, or I'm sorry, not net worth, but average income in that census tract is about $171,000. So it's a really great area, good restaurants, good little, somewhat urban vibe without being too condensed. Um, and it's pretty much all old brownstones from the turn of the century, so stuff in the 20s. So it's a B class asset in that it's basically the price point. So it's something that was built in the 20s. So it's not a brand new build from like the 2000s, like not one of those B classes, but it's more so a B class asset because of the location. But I'd call the neighborhood more of an A class. So there's still upside potential, but like I said, the us doing well with this deal doesn't depend on us going in and bumping the rents up. That's kind of a
Mhm.
bonus if we're allowed to. So
Yeah, yeah. So kind of looking for these a little bit more of a trophy properties, and yeah, I see
yeah,
there's, yeah, I see there's, well, maybe not trophy, but I seen that a lot of kind of people are looking for those deals where you don't have to do a lot of value adds, but at the
mhm,
same time you have those operators who are going and tearing up the office space, or the hotels, and they're doing redevelopment,
yeah.
doing very heavy value add strategies at the same time. So on that note, are you looking to do any other, like, are you looking to invest in other asset classes? Like a lot of operators right now focusing on, mobile home parks or storage units. So any of those strategies that you have in the pipeline?
We haven't put any of our energy into looking at anything other than potentially a mixed use property that could double as our corporate office. But outside of that, we stay pretty narrowly focused on um, our particular niche. With that said, like I said before, we like to look at everything. So we'll definitely look at other opportunities if there's a potential for us to partner with someone who has done that before. So like a development deal, or maybe something in like an office reposition, or, one of those deals we would do if we had another general partner who had done it and has experience, because there's tremendous opportunity there. But we don't want to try our hand at something brand new by ourselves, in a big size. We would much rather be a partner in something like that, do it with someone who knows what they're doing, because it's, just because there's returns to be made somewhere doesn't mean that it's a good idea for you to get out of your lane, right? Because there's a million ways to make money in real estate, but if you get away from the stuff that you know really well, there's more risk that comes there. And Anthony and I are very good at acknowledging that risk and trying to quantify it, where I think a lot of people kind of get shiny object syndrome, and they're like, oh, this is the hot sector now. Oh, storage has been great. Before it was senior living. Now it's, for a while it was little micro units, which is now the complete opposite. So there's always like a new flavor of the month. And we just like to keep it simple. If we know how to do something really well, we'll just keep doing it. And then we look to leverage relationships and partnerships if we want to try to get creative.
Exactly. Look, on the same page. Exactly. Previously, you guys who probably followed this podcast, we had a guest on the show. His name was Michael Becker, and he's a multifamily investor as well in Dallas, Fort Worth area. And he has hundreds. He just crossed $1 billion mark in multifamily. And, that was his basically strategy. The same. He was very simple and simplifying things and just focusing on multifamily only, instead of saying exactly what you just said, going and chasing the shiny objects, where people lose the focus and they lose the attention, which is a crucial piece in business, just staying focused.
Yeah, so again, I think if you're investing correctly, especially if you're into like the trading stuff, like if you're doing it the right way, you should be bored. You shouldn't be like on the edge of your seat. Like when things are going well, you should be pretty bored, basically. That's how you know you're not taking too much risk.
Yeah, I love that. That's a great perspective. So again, talking, if you're still going to continue to look for multifamily deals, which it sounds like how much of the deals do you currently have in the pipeline, and what is your personal goal as a team? Like how many deals do you still planning to close on before the end of this year?
Yeah, so we've been looking at things still pretty aggressively. We haven't found, we've put in some offers over the last few weeks. We just closed on something about 2 or 2.5 weeks ago. So up until we closed, we were 100% focused on just getting that across the finish line. But as soon as we did, we pretty much let everyone know, okay, now, if there's anything on your desk, send it over. And so we've had some things come across our desk, looked at a few things, put out some offers. Given the fact that there's not that many working weeks in December with all the holidays and things, likelihood of us closing something else before the end of December is pretty low. But we are shopping pretty aggressively. So I think we're positioned for something definitely in Q1 of 2021. And we're looking to do at least a deal a quarter in 2021. So right now we're just leveraging our relationships with brokers in the area. And that's been working really well. In this market, there's not a ton of people who are active. So if a handful of people, brokers and owners, you'll catch wind of anything that's about to trade hands. So we're just keeping our ear to the ground and looking to scale pretty aggressively as we move into next year, hoping for just a normal year where we don't have pandemics slow down our business plan. So
exactly. Awesome. So again, can you share part of that? Again, the success is building those broker relationships and knowing people market, and having a lot of dinners and lunches. Of course, maybe there was more of that going before the COVID, but what would you say, biggest your success that you currently have? I mean, 100 units and counting, and you have a goal again, acquiring 900 units over the next few years. So far, what you consider was one of the biggest things that kind of contributed to your personal success?
I'd say it was a combination of putting our message out there about what we were doing. And that's, having a presence online via, having a website and putting out content and just kind of advertising to the world who you are, what you're doing, and what you know. That combined with making a point to prioritize networking, going to events, and meeting as many people as possible. Those two things are things that are very important to advancing in this business, because it is just a relationship business at the end of the day. So the more people you know, that's really the biggest and most important step. Those two things, the content production, brand development, and then networking with people, those are things that are very easy not to do and to kick the can down the road on, because they're not necessarily urgent. There's no due date. No one's waiting for you to do them. No one's telling you to do them. So we tend to get distracted by all those little urgent fires that really aren't that important. So instead of fiddling around with email or, over underwriting deals that don't matter, taking the time to go to an event and do that routinely is really important. It might not pay off for a year or more, but all you need to do is meet a couple people, and you have to actually be in the room to do it. I'm starting to see some more real live events come back, luckily. So as soon as those get back, I mean, the online thing works. We haven't really done any virtual events, honestly, but getting in the room with the people who are doing the thing is one of the most important things. That's where I met Anthony. We met at an event, and you just meet a few people that end up being kind of movers and shakers in that business, and that's your network. So
yeah, exactly. I mean, virtually, definitely. I mean, it works, like us talking right now, but there is a different kind of energy goes between people when they meet physically, and a lot of people are starving for that right now. They want to meet people, they want to go and shake hands, maybe elbows, or I don't know, but that's how deals get done. But at the same time, like, technology is disrupting real estate industry as well at the same time, where personally, like, the multifamily deals, let's say 10, 20 million deals, they're being sold like virtually. Like, people never saw them before. They just did some virtual tour and that's it. They're signing a contract. So that was never been done before. So, and I think more of that will be coming in the future as well, because who knows how long this is going to stay. Hopefully not for a long time. But hey, look. So again, talking about those social media, because again, everybody in multifamily space kind of know it. Being a thought leader in your space is one of the things that people should do, and maybe not should, must do, especially in the digital kind of industry, in the digital age. But can you talk about your personal, maybe social media approach, techniques and tools, and the way maybe you engage with people, through your content that helps you to get that attention, especially in the stance where, it's very hard to capture people's attention with all the noise going in the background?
Yeah, well, I'd say just from a high level, one of the most important things with trying to play the social media game from a branding and marketing perspective is just to be consistent with it and to prioritize putting out quality. And when I say quality, I mean either entertaining or informative content, whatever your angle is. Doing that regularly and consistently for long periods of time is paramount to trying to put together like the perfect video and put something out once every couple of months or something. So inconsistency is just, you might as well not be doing anything, in my opinion. So just being consistent with the social media aspect is hugely important. And then making sure that you're focusing on the right platforms for whatever it is you're doing. If you're Grant Cardone and you're taking pictures of your jets and your rolls, and you're looking to attract people who are into that flashy stuff so you can sell them something, right? Instagram might be great. For people like Anthony and myself, we're looking at working with accredited investors for the most part. We do work with non-accredited, but for the most part, most of the people that we're working with are accredited, and they're putting to work $50, $100, $200,000 at a time. They're not doing that based off of an Instagram post that they saw with some guy in front of a jet. No, they're looking to find someone who's shows integrity and experience, and so that's developed through a different medium. They're not, so Instagram gets none of our attention right now. So it's basically LinkedIn, Facebook, and YouTube, and then podcasts on all the, Spotify, all that stuff. That's where we put our energy based on the types of people that we want to be in front of. And then being consistent with it, like I said, is huge. And then also, having some sort of strategy behind it is paramount. And that's really one of the strengths that Anthony brought to the partnership, was his ability to do that, because he's a professional writer. He's worked on branding and marketing in his other businesses, something he actually enjoys. Whereas, my approach before he came on board was like, I was consistent, but I was just throwing stuff at the wall. There was no rhyme or reason behind like what types of videos I was putting up. They were all basically real estate 101 education videos, which were fine, but there was no there's no flow to it. There's no process for people to follow if they came across my content. I didn't have any kind of sequence of information being presented in a way that makes sense, that you'd want to absorb it. So he brought a whole another level of structure to the social media stuff, and then another level of quality because of his writing experience. So
that is great. So again, that's the importance of having a partner with the different strengths. That's very important. So again, for the one person who is watching or listening to this episode, can you explain what is accredited and not accredited investor, and the way you structure the deals itself?
Yeah, so an accredited investor, and I believe this just was updated within the last month, so I apologize if I get something wrong here, but for the last several years, it's been a annual income of $200,000 a year for the last 2 years if you're single, $300,000 a year for the last 2 years if you're married filing jointly, and or a net worth of $1 million or more, not including the equity in your primary residence. I think that just changed a little bit recently, so but it should be pretty close to that still. So that's an accredited investor, and it's basically putting a stamp on you as far as the SEC and the IRS are concerned that this person is somewhat savvy, at least to a certain degree. They should be able to invest in pretty much what they want, and they are apparently allowed to take a little bit more risk, quote unquote, than someone who is doesn't have those metrics met. They don't have the net worth or the income. So theoretically, those people that don't meet that criteria shouldn't have access to some private investments. Now, the way we structure our deals, we can let those non-accredited people in, but we sacrifice the ability to advertise. So we can't be like Grant Cardone, put up a big YouTube video that says, hey, come into my fund, anybody and everybody, here's the minimum. We can't do that. We have to have a pre-existing relationship with people, which makes sense for us because this all started with close friends and family investing in some of those early deals, and they're not accredited. So, if we start to focus on being able to advertise, then we have to cut out all these, other people that we're really close with. They'll be accredited pretty soon because they've been doing the real estate thing for a couple of years now. But, we don't want to exclude those people from any of our deals because that's kind of our closest little network there. But we're also looking at launching a fund as well sometime next year, which would be something that we could advertise publicly, but would not be for non-accredited investors. So we're looking to add something into the mix that we can advertise, but still, keep those options for non-accredited people there.
Got it. So at the end of the day, look, multifamily syndication business is super simple. Well, at least, when you look at it from 10,000 feet view, like you find a deal, you build a relationship, you kind of market yourself, you brand yourself, you raise capital. So talking about the raising capital process, and maybe technology, and maybe that's a better question to ask, for Anthony. I don't know, maybe we can answer that again, give your own personal perspective. Like, do you see anything, again, it's coming back to the point of disrupting real estate industries from technology standpoint that will kind of help you to raise capital, easier? It's maybe some sort of a technology, or maybe, kind of raising through tokenized equity. Have you came across some, ideas?
Yeah. So I will say that, your point that it's simple is perfect. That's, like I said, that's exactly what I liked about it. Just so people are aware, that doesn't necessarily mean it's easy. And mechanically, it's a very simple process. There's not that many components. There's not that many variables. It's a lot of work. A lot of work. So I don't want to sugarcoat it. It's a lot of hours and time and energy that can go into, trying to get deals across the finish line and then them never actually getting across the finish line. So you could potentially be putting in a lot of work with no real payoff. So definitely not easy, but mechanically quite simple. It's not rocket science. There's nothing too exotic about it. It's not like trying to understand a complex options position or something like that. So that's what I love about it. But when it comes to raising capital, that's kind of a different side of the business that for us sort of happened organically because those early people that got into deals were just friends and family that we didn't, really try to position ourselves in front of in order to raise capital from. It's just, you have those conversations with people when you see them at holidays and on birthdays. What have you been up to? Oh, how's that building going that you bought? Oh, that's great. Oh, well, you just refinanced it and you got all this money back and you're making how much? Like, wait, can I do that? Like, back up. Like, what is all the stuff you just said you're doing? That doesn't seem like it should be possible. And then you kind of explain the business model to people, and then it clicks. Like, oh, so you just raise the rents, and all of a sudden, you could put 5,000 in upgrades into a unit, and all of a sudden it's worth $10,000 or $15,000 more. You start to kind of put those pieces together for people, and they're like, wow, that's really interesting. I would be doing this if I had time. Wait, what if we just kind of did this together? You did the work, I'll put some money in. So that just all kind of happened organically. And so that's just kind of what we leaned into. So all the content that we put out is just education. All we do is talk about the business model, specifically in ways that is understandable for potential passive investors, because there's a ton of content out there for guys who want to be active in doing it. But there's not a lot of content specifically for people who just want to get exposure to that asset class, but they don't want to quit their job, and they don't want to shift to, starting a new business. They just want to get involved. So we just basically educate people. And what I found on my end is, as soon as I learned enough about it, it became a no-brainer. So all we have to do is make sure that people understand the business model, how it works, and then naturally everyone wants to get involved. And if we're the people they've been watching to get up to speed on the business model, then we're probably going to be one of the first people they ping when they want to start doing their first deal.
Exactly. So because of the stock market, it's been preached for a very long time. And when people think about investing, I think still until this day, they think about the stock market first, and then they think about anything else, that's available out there. And again, for the people who are watching or listening to this, you should go to invictusmultifamily.com, and you're going to find something which is free. It's a quick start guide to passive investing in multifamily, because it's all about that. It's basically educating and giving yourself same approach as the show, giving you different options in investing. Because look, multifamily, like real estate, is kind of no-brainer at the same time, especially if you're investing passively. Of course, maybe you just have to be accredited at a certain time, unless you're going to do a fund and you will allow unaccredited investors to invest. But that's one kind of thing. And then understanding, do you like the people, do you want to invest with them? I mean, it's pretty much good from there. But again, talking about what you're currently working on, I mean, you're building this company 100 units plus, and you're looking to acquire far more units, again, building relationships, doing all the good stuff. And the podcast, I love the fact that you have that, which of course, for the people who are listening or watching, you can go to Multifamily Investing Made Simple for the podcast. That's available on Apple, Spotify, Google Podcasts, and get more information and education about what these guys are working on, which is really cool. So besides that, because I asked Anthony, the same question, so I just want to get your perspective. What is your personal legacy that you want to leave behind you as well, besides this?
Let's see. Now the challenge of giving you an answer that's different than Anthony's, but not too different.
Can be the same.
So really, yeah, Anthony and I both have the desire to not just make a bunch of money, but to build a big thing, a big machine, a big creation that has a big positive impact for people. So I believe Anthony's response to this was probably somewhere along the lines of helping 10,000 families or 5,000 families. He's probably said something along those lines. And basically his logic behind that was he wanted to, buy apartment buildings, fix them up, provide quality living, clean, safe properties, and quality customer service through property management to people, and provide a positive impact that way. So my extension onto that is to obviously provide one of the best living experiences in the area from a property management standpoint. There's a few key players in the area that have a really good reputation. When you're going to X, Y, and Z, one of their properties, it's going to be run well, it's going to be taken care of, and it's going to be a good experience. I want to have that type of reputation and provide that type of experience for our residents. And then I also want to provide the resource, knowledge, and education to investors who want to take more control over their financial situation and not just hand over the reins to somebody at Ameriprise. Hopefully you don't get sued by me trashing Ameriprise or any Charles Schwab, whatever, name any of the financial advisors out there. I want people to realize that they have a little bit more control over that stuff than they think they do. It's possible to understand some of this stuff. It's a pretty simple business model. It doesn't take a ton of time, and people can take a lot more control over their money and their retirement than they think they can. So that's kind of the secondary goal that we're trying to achieve, is to try to help people take control over their financial life, improve financial literacy, and show people that there's more options out there other than just working a job, putting your money into your 401k and crossing your fingers and hoping that your retirement lines up with a point in the market where you don't get completely wiped out at the last minute. So
yeah, just like one of the guests that I had previously on the show said, the hoping is not a strategy. So
yeah,
definitely, you, like everybody who's watching or listening, you need to go and explore other strategies as well, which is one of them, again, as multifamily investing. So make sure to get in contact with Daniel personal himself, because probably that will be the best way. You know, if you just have those kind of one-on-one conversations and ask, again, same, probably similar, or maybe your kind of your own personal questions. And of course, there's never a stupid question. You can ask pretty much everything. And again, Daniel and Anthony is available for those, questions. If you're really like passionate about real estate, if you want to invest. For more information, invictusmultifamily.com, and again, YouTube, Multifamily Investing Made Simple, again, podcast. I mean, a lot of great like free resources are available when these guys are putting in time and hours and dedication and work and passion, all of that, again, combined with the personal experience, and give you all these free resources. So make sure to go and check it out. So again, for you, Daniel, personally, I want to say a big thank you again for coming over today and sharing your personal journey, passion, strategies, tips. I mean, there's everything here, so I appreciate it.
Yeah, thanks for having me. This was a blast. So
thank you guys. So guys and girls, before we're going to go, one thing that I want to ask you, if you send this episode to a friend of yours, and of course the best case scenario, if that person is looking to invest in multifamily or real estate in general, so make sure to pass this episode along. Again, Daniel, thank you for coming over today, and as always, I'll see you next time. Thanks for watching.
Thank you.